Welcome back, everyone, to the Kingscrowd Podcast. My name is Brian Belley, your host from Kingscrowd. As always, we are joined by the amazing Kingscrowd team, the industry insider, Scott Kitun, and our two amazing senior investment associates, the investment team, Teddy and Léa. Welcome back, everyone. Each week on this podcast, we are looking to bring all of you more data and insights on the online private markets. So we take a look at some of the different trends and some of the different topics that we think will help make you a more informed investor and a better capital raiser in these markets. Today, we have two topics we want to talk about. First, on our news segment, we're going to be getting into some risks that investors, especially retail investors, perhaps don't know or don't think about up front. So we're going to be sharing an anecdote from an investor that shared this news with us, where they had a company that essentially IPO'd, but many of their investors in that company weren't able to participate. So we'll be talking about some of that. Then in the second part of the segment, we'll be going into this week's data-driven chart of the week. We're going to be taking a look at valuations versus revenue buckets and some really great takeaways there that Léa put together. All right, let's go to the first segment today. So we're going to be diving into some news that an investor reached out to us, and feel free, anytime, anyone can send us an email, help@kingscrowd.com. We love hearing from all of you. And honestly, it gives us just more topics to talk about to increase awareness. We want to educate everyone who's here to help make you better investors and better founders. So we had an investor reach out to us that talked about a company that they invested in 2022 called Microsalt. I'm going to pull up my screen. So this company did a raise on Microventures back in 2022. Now, in 2024, in February of 2024, as you can see here, they IPO'd on the London Stock Exchange. Now, where the story gets interesting is that this investor informed us that they were not able to participate in that IPO. Now, why is that? I did a little bit of investigative work, and if you go to the Form C, you can actually see this is their original Form C for this company back in 2022. You can get this online or from the Kingscrowd website. It says that this company called Microsalt Inc. is a Florida corporation. However, if you go further down, you will see that this company was essentially a spinoff for this other company, Solarius LLC. And you can see it gets very confusing in terms of the corporate structure. So try and keep up. Solarius Limited was basically the owner that purchased that. Who is Solarius Limited? If you go further down, you can see that Solarius Limited is actually a UK-based parent company, and they had 87% ownership essentially in this company. Why is this all important? So the issue that investors ran into is that despite this company that they invested in, Microsalt, IPOing on the London Stock Exchange, most of those investors in that Microventures round were not able to participate. So their funds are still locked up. Now, some of this is perhaps because some of them may have been non-accredited, and sometimes there's issues if you're accredited versus non-accredited investor, but other things are just because of the structure of this deal. So Scott, I want to bring you into this conversation, so I stop blabbing here, but taking a look at this, and you have a wealth of knowledge and obviously a lot of experiences, both the founder side and the investor side, but what do you think of this, and have you seen kind of other similar things to this?
Yeah, I mean, I've seen this happen, not crowdfunding. Like I've seen this happen with several companies that I'm familiar with that were not the investors. I was not an investor in the company, but know several who were, and they actually did get out, but and there was no issues for them, but the people below them it was, and they went on the Toronto exchange, a couple of healthcare companies. And effectively, there's a lot of nuance here. I mean, one, I don't want to spend a bunch of time on this part, but there are types of companies that other, countries and exchanges will and will not host. So like cannabis or healthcare that touches cannabis, or crypto or banking that touches, these things. And it's getting a lot, easier and deregged, on almost a daily basis. But the outcome is that a lot of these companies have created frameworks to enable them to take any money they could in the beginning, don't care, need money to live. And by the end, when it comes time to get out or protect themselves, or at least protect the capital that is the majority of their ownership stake, they do stuff they have to do, or at least they deem it. And we all wish that people would just, lay on the sword for us where our money should all be equal, but it just isn't. And so it's not like an uncommon practice, which, ultimately brings in a different conversation, which is one, why Kingscrowd exists and why it has to exist. And two, why education is such a huge part of like the investment thesis, because the reality is even the best, most professional investors like have a hard time determining what will be successful and who's a good founder and who's the right structure and what, like no one knows really truly how it's going to begin and end. And so the odds of a retail investor doing that is like even less, or if it's just a guesswork, then I guess it's even Steven, but like you still should know the deal. And I think that's where we need to start. And I hope that this is kind of one of the things I'm trying to work on over the next, 6 months or so, is like make people understand the types of investments, the types of deals, how they look, what they should look like. Do I think that the salt company here, Microsalt or whatever, like is a bad company? No, obviously not. It IPO'd or whatever. So hopefully that was a positive outcome. But like it should say, and they didn't, by the way, for the retail investor, they didn't like bury it. It's just it's like not hidden. It's just, it maybe seems that way to investors because they're not used to looking through all this stuff, but like it's not nefarious. They just did this. I think that there should be warnings or like, and that's on us at Kingscrowd to create risks that just show you that like if you're not a long-term big money person, you probably should invest in stuff that has overseas complications, different investor types that are coming from, sovereign wealth funds and things. Like the more complicated these deals are, the very, very hard it becomes for you as a regular Joe to like actually get out. And I think that's kind of what happened here. It's happened a lot of times. There's, you're just the digital version of what a lot of early angels experienced from like the 08 through 13 investment in companies like Telegram and others that are fucking massive. But if you were like a small potato investor in the beginning, like they found ways to bury you and you're like the last person on the call sheet. So, I just think that we need to do a better job of learning and explaining what this might mean. And, unfortunately for those investors, this is going to be a learning experience. I actually don't know, Brian, maybe you do or Teddy. Will they be able to get out? Like, how do they get out? What's the scenario?
Yeah, so if you look into it a little bit more, all of these investors from communications by the company still own the exact number of shares that they had in the same company, Microsalt Inc. Now, that's the US-based kind of subsidiary of this parent company. So I'm sure, there wasn't intentional malintent, I would assume, where, it's for a bunch of reasons, and it's probably, just in terms of capital needs and legal structures.
Probably raised capital this way through crowdfunding, and they couldn't do it from the UK at the time from this stateside investors. It's probably what happened.
It could have been that. But and again, maybe this ends up being a huge success story 5 years from now, but understandably, right, a lot of these investors claim they didn't know when they got into the deal, and so they're upset that they can't access the capital, access the markets. Teddy, a different example of this, I know you had a company you had invested in that was acquired, I believe, and some of the investors were given an option to participate in the follow-on, but others were not. Do you want to share what that?
Yeah, so this case, a little bit different. It's a company called Oncolyze, kind of another cancer treatment company. They were targeting AML, which is a very aggressive form of leukemia. They had very good animal studies. They had a designation with the FDA that allowed them to do a much smaller human trial. So anyway, point is all the aspects of what I look for in an early stage pharma company. So I was a big fan of them. I invested in them. And they eventually got acquired. So less than a year after their crowdfunding round, they actually got acquired by a larger drug development company called Vaccinics. And basically the structure of the transaction was Oncolyze was merged into and became a subsidiary of Vaccinics, and Oncolyze investors received common stock in the acquiring company Vaccinics that was equal to the value of the Oncolyze stock at the time of the crowdfunding round. So initially I was like super excited about that. I mean, anytime a early stage pharma company gets acquired by a larger one, there's more capital, more connections, and just a higher potential for the drug to actually become commercialized. But as you kept reading, they said that because the merger was being done as a private offering under the Securities Act, they could only offer shares of the acquiring company Vaccinics to accredited investors in Oncolyze. So basically, you couldn't participate in this merger. You couldn't get shares in the acquiring company unless you were accredited. For non-accredited investors, Oncolyze offered money back plus 10%, which of course it's not bad. It's under a year since investment. You get your money back plus 10%, but you do not get to participate in the upside that I saw in Oncolyze. So that was like kind of annoying for me because I had invested in the company like 8 months prior to this, and I was really excited about kind of the long-term upside of Oncolyze. And instead of being able to kind of participate in that, I got my money back plus 10%, which again is not bad. Most startups go to zero, but it was just an interesting example of how this Securities Act, like in the name of protecting non-accredited investors, like actually kind of screwed them out of the potential upside and kind of the whole point of startup investing.
Honestly, I would probably take the dollar plus 10% and just be happy about it. You're probably going to end up better off in the deal than the other guys. Maybe not though. Who knows? I kind of laugh at this because I was just preaching, facts and transparency and research. Most of these groups, like for qualified purchaser, it's a different story. But for accredited, like they don't really do that kind of like much research. And I'd look at it like by the time this drug hits the market and there's a real payday, it's probably 6 years from now.
Mm-hmm.
Which by the time we hit that, I probably will be accredited. So fuck it. I'd probably just fill that shit out and say I am accredited and just do that. Like 5 years later, they call you and it's like, now I am. By the way, you won't be the only one doing that. I was literally just talking to a couple of people who are like, what did he called himself accredited adjacent?
Well, what is self-certified? When you're like self declaring that you're like, they don't actually check anything. It's like,
no. So like literally, if ever there were a checkpoint, Brian, you'd know more about how they go about it. But like, if there's a checkpoint and it's like 2 years, 3 years from now, like I'm just clicking yes because I'm
the difference too. If, like private offerings 506B, you can self-certify. So a lot of those, it could be people, and understandably, right? Like the threshold for accredited investor, we could talk about that all day. It's this income net worth threshold. What if the stock market, you're like right on the border, stock market goes up 5%, you're accredited, down 5%, now you're not. Like whole separate discussion. I think SEC, it's being talked about at the SEC, so they'll be thinking about that. But the other thing is if it's a 506C, it's a more stringent process. You have to like submit paperwork or have someone like a CPA or something sign a letter that says you're accredited, that they reviewed your bank statements or your income. So it depends on which type of offering. But yes, this is not recommendation to go and do that by any means.
No, this is not advice. I'm not giving people advice to do this. I'm just saying it's been done. The guy who is accredited adjacent, by the way, to put a bow on it, he was like, well, I live with my parents who are fucking rich. And he's like, I live in the basement like these rich people. It's like, I have money. Like, it's whatever, man. And it is like, he just does it. Like, I laughed so hard. I was like, oh my God, the SEC can't figure out quick enough how to like literally, like I just spoke to a guy on the committee, Vince Cordero, who I mentioned to you, Brian, yesterday. And he was telling me how like they are all SEC wise is like all systems go on at least like unblurring the lines, whatever you want to call it, making accreditation be a little bit more loose. And one of the main reasons is exactly this, like Teddy's point that the ruling is what actually hurt the non-accredited, but actually there's just so much blurry, line crossover. Like it's just too much. And it's, at the end of the day,
acknowledge the risks, my opinion, right? Like, okay, totally. You've done a few deals. Honestly, crowdfunding can be great for that. Like make a few $100 investments so you don't have, you're not risking a ton. So you have an understanding. And then it's like, cool. Now, if you want to write a bigger check and go out, write $1,000, $5,000 check, go for it.
Also, they like, if you do the math, the vast majority of people we're talking about here are not $500 and $200 and $100 investors. The people who are like very close to being accredited, if not accredited, or like on that line, are making like $1,000, $5,000, $10,000 investments here. That's the people that like we need the risk and the sort of diligence and regulatory action for. They're so what? So some guy lost $200. Like that is not who we're trying to like. I know that's what we like to talk about. Like that's who we're protecting. But the reality is there's 25 million people in America who are on the border of accredited, who have enough that they're cutting $5,000, $10,000 checks. We just want to make sure that they're not putting it in dumpster fires or scams, which again, to circle back and go back to the Microsalt here, this is why it's so important to read and to learn, even if you're practicing with public market stuff. Like I was mentioning Levine, however he pronounces, from Bloomberg, like his piece today on the, effectively insurance on the market. Like it is little things that we can all get better at learning and understanding so that you can tell right away. Forget about whether or not you think the company is a good company or the fund's a good fund, whatever. Like, is it set up for me to be successful? Like with my money and my timeline, which is very different than somebody else's. And I think that's kind of what we're all here trying to solve over the next decade, right? Is that we're trying to create a world where we understand all these investors. The modern investor has their own timeline. They want to retire at this age and this age and this age, and it changes, and they have kids. They don't have kids. They don't buy. They do buy. Like life is very different than it was for our parents. And so we're really trying to create an environment where you can identify or self-select like what's good for me. And then once you've passed that threshold, like then let's talk about the deals type, and then let's talk about the company type and the return profile, all this kind of stuff, which by the way, also all available at kingscrowd.com.
Yeah. Well said, Scott. Just if I were to make a point, right, why are we bringing this up? It's not to scare people. It's not to deter people from this, but to Scott's point, like have an understanding of what you're investing in going in. It's not just picking, is the business going to succeed or not? You have to think about, unfortunately, more things like the financials. How is the company structured? Does it have a foreign parent, entity or something like that? These are just all other things that are smaller risks, but if one of those things in the chain ends up going bad for some reason, it can impact your ultimate investment. So just go in with eyes wide open. Take away from that. So we'll be talking a lot more about different exits and outcomes as well in coming episodes, but I think today we will wrap things up there. I want to move on to the next topic and welcome back our Senior Investment Associate, Léa. Léa, welcome back. We are going to be diving into your chart of the week this week. So I'm going to pull it up on my screen, but how about you tell us what we are taking a look at?
Hi, Brian. So this week we are taking a look at companies' valuation based on their revenue brackets. So what that means is that we basically grouped raises based on the latest annual revenue. So here we can see that we group pre-revenue companies together, companies with less than 50K in revenue together, companies with less than 100K in revenues together, et cetera, and try to see what was this company's valuation to basically understand whether valuation and revenues were linked together. And so that's a very good benchmark for investors because if you take a company, look at the annual revenue, you can kind of come to this chart and try to figure out whether the company is overvalued based on the whole market's benchmark. So at the bottom, what we can see is so the company's annual revenue bracket on the x-axis, and on the y-axis, the company's valuation in dollars. So maybe, Brian, we can take a look at the chart where we have all the companies. So as you can see, this chart is absolutely unreadable. And the reason is that there is one huge outlier up there, which is called Boxable. We've talked about them before. They are valued at more than $3 billion. And so, well, we just wanted to show you how much Boxable is overvalued compared to the rest of the equity crowdfunding deals. Next, here we have a chart that shows every raise in the last 12 months except Boxable. So we still have a couple companies that are valued pretty highly. So, for example, Emer's a valuation of $300 million, even if the company didn't make $1 million in revenue yet. And maybe that one, Ground Floor, valued at $289 million, makes a little bit more sense because it's in the highest kind of revenue bracket. But really, what we wanted to take a look at is a chart where we kind of remove all of the companies with more than $100 million in valuation so we can get a good idea of what's happening. So I'll let you tell us kind of what are you seeing first when you're seeing this chart?
Yeah, the very first thing I always come to with this is people, I think, picture that it's going to be a straight line from pre-revenue companies being the cheapest all the way through, if you were to make a naive assumption, it'd be a straight line of increasing. What you see is there's actually a dip where there's actually a lot of higher valued companies that are pre-revenue than the lowest bracket. Now, when you think about it, that makes sense for a couple different reasons, right? A lot of these companies that may be pre-revenue are some of these more moonshot, potentially like biotech pharma companies that like Teddy, talks about a lot, where they might not have a lot. A lot of these like LPP Fusion, pharmaceuticals, Olympian Motors. So a lot of them are very capital intensive, and it could be as well that, they're famous founders or big teams. They're not generating revenue yet. They're more perhaps trying to get like venture scale and then start charging and monetizing. But typically after that, you do see that there is slightly an increasing trend. Teddy, Scott, what do you guys see when you first look at this chart?
This is a well-known, well-reported flaw in the system known as the $1 million theory. If you cannot produce, some people say $500,000. Today, it's probably higher because everyone's investing in post revenue. So if you have revenue, it's artificially inflated. Just because you have revenue doesn't mean you can keep having revenue. But generally speaking, in the venture space, and I think it's a psychological thing. I don't think it's just venture. Mm-hmm. So it applies to everyone here. There's an assumption before you hit go or you start taking in real revenue or you're like out of beta that like anything is possible. And if I put something wild like $1 trillion TAM on a card in front of you, you're like, fuck, it might be happening. Like it feels possible. And then I start showing you progress. And it's like, I only like dabble in doodle like $5,000 a month. And like MRR is kind of like 1,000 to 10,000 or 20,000. And there's no commas. And you're like under $1 million and you stay under $1 million for more than a year. There's this like immediate, which you see represented in this line here, an immediate pullback and dip where it just becomes like all things are worthless. And then if you can show outsized number, $1 million, you'll see it at that, over $500,000. You see the 100 to 500K and you see over $1 million, $1 million plus. That 1 to 5, the candle starts popping and it just goes up from there. And of course, then, that's a different story post $1 million. But this is like a very common thing. It's been this way for a very long time. This is why founders struggle with like, do I raise capital beforehand? And everyone's like, no, man, just go live and like, then raise. It doesn't work that way. If I go live with a good idea and I don't have money to invest in marketing it, so therefore my revenues are low, you then tax my like everything because you say I can't produce revenue. So like you're better off holding it, selling the vision, showing all the like anecdotal pieces that prove your theory, raising the proper money once you have like a select audience you're going to sell into. And then you damn sure better hit that $1 million target before you raise again, because otherwise you will be swimming in the deep end very quickly.
The way I've heard it described is kind of when you're still in that pre-revenue phase, you're selling, like you said, the vision, it's the dream. And people are like, okay, yeah, I can see that. You're going to make, $10 million within 2 years. But once you start actually making revenue, it's like, okay, it's either happening or it isn't. And
I mean, I'm not calling people out, but there's snake oil salesman component cultiness that founders have, which is why they gravitate to this kind of stuff and they don't have regular jobs because they just can't, like, they're just weirdos. But like anything else in the world, there's only like 1% who are really talented. So you see this like 7,000 dots straight up to $100 million valuation in pre-revenue. And then it immediately the herd thins by half, like as soon as you get to the million.
Have you guys seen Silicon Valley, that show?
Yeah.
You know that scene where Russ Hanneman's like, why would you go after revenue? If you show people revenue, they'll ask how much and it'll never be enough. And the 1,000 extra becomes 2x dog. So
this is my not hot dog app.
Yeah. Yeah. I mean, yeah, I agree with everyone. I mean, it's, when you're pre-revenue, you can kind of just bake in the upside and be like, well, yeah, it's, especially with early stage pharma companies, but it makes a little more sense because given how capital intensive that industry is, that, company that's, approaching phase 1 human trials, 60 million, 100 million valuations are like very common and make sense.
Biotech.
Yeah, exactly. Right. Siren Biotech, great example. Like 60 million is an absolute steal for that company, in my opinion. But
ask any mom or dad, and the dream of getting married and having small children far exceeds the reality of getting married and having small children. Same thing applied to investing.
Now, it's actually interesting. So Léa, you did this chart. If we go back 2 or 3 years from now, August 2022, and very familiar shape right here, right? It's kind of showing this is the average valuation, but we see the same impact here.
Exactly. Yeah, it's average. So the numbers are a little bit different, but we see the exact same shape where it dips around 50,000 in revenue. We're probably investors, as you were saying, are realizing that they shouldn't be paying as much for a company that is making that little amount of revenue. I also think that the type of company is just different. Like we're going to have a lot more CPG companies in the zero to $500,000 bracket, a lot of them starting. And so they just cannot be valued at current valuation. It doesn't make sense. Well, as Teddy was saying, we have a lot of companies that are raising either deep tech, healthcare at pre-revenue valuation. And they may, once they start actually getting contracts, getting real sales money, move to different type of investors, move away from equity crowdfunding back into getting money to institutional investors. And so that's probably one of the reasons why maybe we don't see them in later stage once they start getting revenues.
I think we'll wrap things up there. This is another fantastic discussion. For everyone who's watching out there, as we mentioned, both, if there's charts and data you want us to dive into, let us know. Respond to this video, send us a note, help@kingscrowd.com. And also, if you have investor stories or other things you want us to talk about in the news, get some of our opinions, feel free to send it over to us. If you haven't already, go over to kingscrowd.com, create your free account. You'll get all this great info. You get weekly updates from us via our newsletter and other great investing and capital raising insights. Until next time, we'll see everyone back here on the next podcast. Thanks.